Okay guys, this is Chris with Investing with Chris, and this is an exclusive video for you guys here on the investingondemand.com platform. I want to go over something called stock option Greeks. This is probably one of the most number one questions that I receive when getting into, or when someone gets into stock options trading, is how they work, how they're priced, and this also is basically going to cover all of that for you, hopefully, and get you to understand how the options work when it comes to the different pricing structures and all that. Stock options are a little bit different when it comes to just ordinary buying low and selling high. It's basically a contract between you and another person. So a stock option contract is leveraged. It basically requires less capital, but allows you to trade on a bigger position theoretically. So instead of buying 100 shares of something, you're doing one stock option. Remember, always one stock option is per 100 contracts, or 100 shares, sorry. So one option contract equals 100 shares. So this is where you get the leveraged position in managing 100 shares with less capital. So I'm going to go over this, understanding stock option Greeks, and hopefully, again, this is going to help you tremendously and clear up some questions that you normally have when it comes to stock options. So before even trying to trade or invest using stock options, it's highly important to understand how they are priced and overall the Greeks. The Greeks paint us a better picture as to how stock options could be priced and how they change accordingly to the stock's price and volatility. With that being said, picking a stock's price direction or a stock option direction can be difficult, as options are already complex enough as it is. However, understanding things like implied volatility, historical volatility, and IV rank can help us determine a little better when it comes to the potential move or direction in the near future. Hence, near future. Along with understanding IV, historical IV, and the options IV rank, we must also know and understand the Greeks. Snap a picture of this. Delta, gamma, theta, vega, and rho. It's probably a lot already. Understanding the IV, historical IV, options IV rank, and now I'm throwing this to you called the Greeks. Wow, a lot of information, right? Once you get to know this, you're going to pretty much think, wow, I guess should have got into stock options a lot sooner. But as I say, and always will say, this is probably one of the number one reasons why people do not get into stock options trading, because it is so difficult and there is a lot of different things you must know up front. So here we have a graph that I created for you to hopefully paint the picture clear, and that is you have an option price, and that's broken down into two different values: intrinsic value and then extrinsic value, which is time value, so later on, or something of time. It's not really the price right yet. And then the intrinsic value is that price today in the future, or what the price is now. So under delta and gamma, that's the current price, and then delta and gamma again affects the strike price. So within the current price and strike price, you want to look at delta and gamma. The theta is simply the time to maturity, and then vega is the volatility, and then rho is the rate of interest. We usually don't normally, if that makes sense, we usually don't use rho. I keep that out of there. Anytime I'm looking at an options table, I do not use rho for the majority of the time, nor really vega. I want to look at implied volatility and all that, but I usually don't ever even usually have vega up in within my settings. So the three main that I usually look for is delta, gamma, and theta. So the Greek delta, and what's it mean? Delta is the change of price in an option if the direction of the move is $1 up or down within an underlying stock. So calls have a positive delta between 0 and 1. Puts have a negative delta between 0 and -1. Delta also is very close to the probability of success. Example, if delta is 40, then the probability of being in the money will be close to 40% or 60% out of the money. Just flip that. This also means if delta is 40, then the price of the option will move or decrease by 40 cents. However, remember, one option contract is 100 shares equivalent, so the 40 cents is really $40. So if we have a delta of 40 and the price of the stock moves up $1, that option contract now increases in value by $40. And on the flip side, if it goes down, it loses $40. So here we have an option table, and this is what it normally looks like anytime you use the Thinkorswim platform. And over, as you can see on the left, I have delta, gamma, theta, vega, rho all set up. Then probability in the money and probability out of the money. And now I did say that delta often and very closely compares with the probability of in the money or out of the money. If we see the delta in the picture being of 38 cents, the probability in the money is pretty much 38.8%. That means there is a 38% chance that the strike price will go up to that 830 or 8330 range. Now, probability of out of the money means that it has a 61.9% chance of not going up to that. So statistics does matter in options because it's given to us right here. That's the power of stock options. They are priced perfectly, and the statistics also are shown to us. So something of being delta of 38, which for every dollar it goes up, you're earning $38, there's also a lesser chance. Now, if you look deep in the money, which is the colored of to the upper section of this QN4X19, the 8150, 8160, 8170, so on and so on, all the way where the color coding changes or is no longer highlighted down to the 8290. I'm looking at the strike prices, and if you look to the left, which is the call side, you can see the calls versus the puts over on the right side. The calls are all in the money because obviously the price is right at 8290 and 8300. So with that being said, the deeper you go in the money, which is the colored section, your delta is actually more. You're going to pay for that though. As you can see between the bid and the ask, the 149.75 and the 164 for that strike price of 81.50, you're getting a delta of 81, but you're having to pay $14,000 for that, or $16,000. Remember, 149 times 100, because we're always messing with lots of 100. One option contract equals 100 would equal out to the $14,975 or the 164. Okay, so if we look over to the put side, it's almost the exact same way. You have a 20% chance or 33% chance of that stock dropping to those numbers. And if you look at probability in the money, it almost is the same. So that would reduce the needed amount of space for these columns, and you can basically take off probability of in the money and probability out of the money. I don't even have those in my settings. I do here just so I can show you that. So I always just have delta up, and that will tell me my options probability of in the money or out of the money. It correlates almost to a T. So let's further look at the Under Armour, and it will show us the deltas go lower the farther out of the money for both calls and put sides. This farther away from the expiration date, we can also understand that the delta is more as we can get, or as we get closer to the expiration. The deltas become less in value due to the theta or time decay. So if we look at the theta on the call side, you'll see zeros all the way down to where it basically gets at the strike price of the 15. Well, Under Armour at this point that I took the screenshot was trading at 17.33. So everything is in the money below 17.33 on the call side. On the put side, it's the opposite. If we look at the theta, they're basically, you're losing a dollar, a penny, a dollar every day that the stock does not go up for the call side. On the flip side to the put side, you're losing a dollar on that side. Now, this means the buyers of this call contract, if you're a buyer and you're buying calls, you're losing $1 every day that stock does not jump up to 17, 18, 19, so on and so on. It gives that to you right there with the first three strike, the first three strike prices, the 15, the 17.5, and the 20. If you look over to the left on the call side, the theta is $1. Everything else, you're not even getting anything because they're already low valued, so there's nothing to lose. But if we're looking at that 90 and 93 cent, and 20 and 22 cent, and 5 and 6 cents on that 17.5, 20, and 25, there's a little bit of value there. And actually, the 22.5 does not even have any theta. It's just on the 15, the 17, and the 20. So that's explaining the theta. For every day that goes by, you're losing that much on that option contract. So Greek gamma, knowing what delta is, we can think of it as the speed of which a option changes price. Gamma is the acceleration of a price or pricing of an option. The higher the gamma, the more responsive that option is to changing option prices. So when buying calls, we can see for the 17.5 strike price, the ask on the call side is $93 or $93. If the stock was to move from 17.33, which is the last price that Under Armour was at, see the circled price, to 18.33, then the 17.5 strike price call, having a delta of 51, would be $51 more in value. So that's just for the first price or first strike, first point move up. If the price of Under Armour was to go from 17.33 to 19.33, we would then take the delta plus the gamma, which is 51 cents, and then also 16 cents, which would now be $66 more in value. Then every dollar move after would be again more of the delta plus gamma. This goes for the flip side. If a stock was to drop, you would lose delta and gamma. So basically we're saying that for every dollar up, the first dollar, you're only considering the delta. So Under Armour jumps to 18.33, we make $51 on that 17.5 strike price contract. If it goes up to 19.33, now we're getting the delta plus the gamma, which equals out to $66. So we're getting the first 51 plus 66, and you can do the math, and that's over $100 that we now have just made. For the 20 strike price, you're getting 17 cents, and my line looks like it's crossed through, I think it's 11. So for the first dollar up, for that 20 contract, you would be making $17. And then every point after, you'd get 17 plus the 11. So you'd get 28. But obviously, you're paying less for that contract. So you're making less. The more you pay, the more you'll make. That's why you see the deltas in the 5 and the 7.5 are $1. So you're getting $100, but you're also paying $1,200 for that. Okay? Where you pay more, you make more. Where you pay more for less risk, or you pay less for more risk. Because if you pay, for instance, at the 30 strike price, it's only a penny. But look what you're getting in delta. Nothing. And it's also very unlikely that in 60 days, Under Armour would go up to 30, is basically what the system is saying. Now, this is the algorithms that this system sees, and it gives you your probabilities from past performance, certain moves, etc., etc. So, when buying puts, I'm not going to go into why you would buy a put simply for insurance or other reasons. Real quick, if I was to own Under Armour, I'd buy a put at, for instance, 15. If it drops below anything below 15, I still get to sell my Under Armour at 15. I'm going to pay for that, though, that insurance. I'm still paying for it. You pay for your car insurance. So as you're paying for car insurance every month, you're either going to use it or you're not going to use it. But thankfully, when you do have to use it, you've paid money for it and it's covered. So as we can see for the 17.5 strike price, the ask put side is $1.04 or $104. If the stock was to move from 17.33, which is the last price for Under Armour, as you can see for the circle or at the circled price, to 1633, then the 17.5 strike price put having a delta of 49 would be $49 more in value. So meaning you could actually sell the contract or keep it, whatever you want to do. You could sell it and make money. If the price of Under Armour was to go from 1733 to 1533, we would then take the delta plus gamma, just like we did on the call side, add them together, which would now be $66 more valuable. Again, $66. The other one was $66, just in a different way. And now you get $66 again. So that every $1 move after would be, again, more of the delta plus gamma. This goes for the flip side. If a stock was to drop, you would lose delta and gamma once again. So as we can see that the closer to the strike price when looking at gamma, it is higher. The farther away from the strike price we go, the gamma becomes less. This is important to know as options are favorably priced in the market. The farther away from a strike price, the odds of being in the money become less. Prices are cheaper when buying options, but also the odds are against us. This is why selling options out of the money, hence selling options out of the money, are more favorable for professional investors. Now that we understand how delta and gamma work for both buying calls and buying puts, the opposite happens when selling them. Buying a call is assuming or wanting the stock price to go up. Buying a put is assuming or wanting the stock price to go down. Now let's flip that. Selling a call is assuming the stock will go down. Selling a put is assuming the stock will go up. I do have a course on this. I also have some ebooks, investingwithchris.com. You can find those. If you've got any questions, always ask. Find me in the group, whatever you want to do. So, Greek theta. Theta is time decay, the amount that is being lost in value per day as the expiration day comes near. The farther away from the expiration time decay is less. By looking at various pictures below, we can see that the last 30 days, the time decay curve, 30 days, becomes much more rapid and drops off. This is why I like selling options 45 to 30 days, because I know that those option prices become less and less and I can buy them back a lot cheaper. So I'm selling something, shorting it per se, and then buying it back at a cheaper price. That is profit. If I sell something and then have to buy it back for more, guess what? That's not profit. That's a loss. On the flip side, if I'm buying an option and selling it for higher, that's a profit. But I always like to sell calls, or not sell calls, sorry, I'm not going to say that. I like to sell puts if I'm already interested in a stock or I don't think the stock will go down to that price. When you sell a put, you're basically taking in premium. If you're looking at already buying a stock, I always stress to people, why just buy a stock at a certain price that it is today and give up money when you could sell a put for a lower strike price, make money for sure, and if that stock price drops, guess what? You're really not out anything because that was the price that you was, or that's the stock that you was wanting to get into anyways. Now you're just in it for cheaper. Now you don't want the stock to continue to drop, but the goal is to then flip to the other side of the table or the market and start selling covered calls against the shares that you got assigned to. And I'm not going to go into all this. This is in my courses and the basics of stock options and options trading. But anyways, this is the yield curve or the curve, the time decay curve that I like to sell options or especially puts within 45 to 30 days. And this is why, because they drop off tremendously within that curve. Theta being time decay, it is an option buyer's nightmare. The value of the option decreases every single day. They're losing money every single day if that stock does not go in their favor or it doesn't really go up in a huge increase. The decay of the value increases faster and faster as it nears expiration, and therefore the direction of the buyer has to be right. Investors who sell options, theta is on our side or their side. So theta is the amount that the option loses each day. This will always be a negative. Always be a negative. Doesn't matter if you're a buyer or a seller of an option. It's always a negative value. It's a negative value if it works in your favor as a seller. Theta having -3 is 100 times the -$3, which will be lost every day for the November 22nd, 2019 17.5 strike price. You can see in your data see the theta And every single one of these option tables, I've given you various tables that I dropped down to so you can see those amounts. So Greek, VEGA. Remember, VEGA is the change of an option's pricing due to the volatility. It is based on a 1% change, and if nothing happens to the stock's price, the option price will still go up according to the VEGA. The VEGA, look at this. I basically circled them, squared them off for you so you can easily see them. Remember, if the stock price or the option does not change, the VEGA will still go up by $1, $2, or $4. Whatever the VEGA is, the price could sit there and stay the same. So if we take a look at that, correlate it with the theta, what's happening? You got to do the difference on both sides. The theta in this November 19, which is 4 days to expiration, if you're looking at the left-hand side, under the call side, we see the strike price at 17. The VEGA is 1, but then you see theta at 3. So the stock could literally stay at, or Under Armour could stay at 17.33. We're losing $3 of theta, but then we're making it up for VEGA. So technically that's only $2 a day that we're now losing. Now look at the December 20th 19 contract, 32-day expiration at the 17. I've highlighted it at 2, but then look at the theta. So the option actually is making money if it just sits there. It's losing value on as theta, but then it's also making up for VEGA. So that's also important. Do I really look at things like this? Not really, because more than likely the stocks always go up, they go down, they go up, they go down. I always do like to watch a stock's pattern, how it reacts to certain conditions, and also around the earning season or earning time. Every 3 to 4 months and around, does it go up the last week or does it go down the last week and then pop up? What's it do after earnings, etc., etc. So the Greek rho. Rho is the interest rate or change of the pricing in an option based off the average 90-day treasury bill or something similar. This too is based off a 1% change. This is a little difficult to throw in here because you're looking at gamma, theta, delta, VEGA, and now all of a sudden this 90-day treasury bill. If the 90-day treasury bill is at 2.9%, guess what? The options are usually going to adjust for that inflation rate or that interest rate. Basically, the 90-day treasury bill is somewhat like an interest rate or an inflation rate, sorry. So if it's at 3%, then it's going to adjust for that 3% inflation. That's all that is. It's really a correlation with how the market or how the economy is doing. Okay, so that's it for this lesson. Stock option Greeks. Wow, a lot of information. Again, remember, delta is correlated with in the money percentage. So if we're looking at delta being 42%, we have a 42% chance that that stock will be at that price before expiration, at or before expiration. There's also one little key thing that I want to point out, and I noticed I didn't mark this just because it wasn't part of the actual Greeks. But if you take a look over to the very far right side, I'm going to try to move my mouse over there. And if you look right here, these percentages, these are also something highly important to remember when correlating it with this. If we're looking at a 17.5% chance of the stock being at this strike price at expiration, we're looking at delta 42. We also see it has a 40.85% of being plus or minus 0.63 cents. So this stock could go up 0.63, and basically TD, or this algorithm, is showing us it has a 40% chance of going plus or minus. Now if we correlate that with our delta, the odds are pretty good at being or not being at 17.5, especially 18, etc., etc. So just always keep an eye on these statistics over here off to your right-hand side as well. This is one of the important things I always like to trade off of is delta. Depending on if I'm buying or selling, I'll go different points of deltas. But then I also take a look at this, so keep that in mind. There's also some bonuses that I want to throw out there, like implied volatility, historical volatility, and everything. Always make sure you're watching that too. And if you don't know how, I do have an ebook on it. I gave a lot of theories and how I use it in all my trading over at the investingwithchris.com website. You'll find the ebook section there. And if you're part of my members group or the investors club group, you'll get those ebooks for free. So make sure you guys are signing up for that if you haven't already. So anyways, that's it for this video. If there's any questions, definitely don't hesitate to reach out, get a hold of me in the group, whatever you may do. And until then, happy trading.